What's going on, traders? How we doing out there? Who's ready for another Money Mitch? I got another perfect show for you guys. We're going to be getting into, of course, the CPI data, talking about what we potentially could have. Are we going to see that decline, or are we going to see a hot number? We're going to definitely pay attention. This could be a big reason why we could see a rally tomorrow. Of course, today we were watching some short action. We got some stocks that were bouncing a little bit. We'll talk all about these stocks coming right up on Money Mitch. And of course, our interview with Jay Hatfield, founder and CEO of portfolio manager at Infrastructure Capital Advisors. Stay tuned, guys. We got a great show for you.
It's time for Money Making Mitch. When investors need a story, we're going to the moon. Welcome to Money Mitch, where story is everything. I'm here to find you the next opportunity. It's all about the green hands. Now we all know the bull market is here to stay. Money Mitch.
All right, traders, how we doing on out there? Let's go ahead. Let's dive right into the market and see what we got here. Of course, you guys can see the SPY struggled today. We did close kind of underneath the open there, so going into the red just a little bit there. But one of the things that I could clearly see is this resistance that was building on up. And if you go back, you can see how we've kind of been holding resistance off of these levels around here, and we're not getting above these levels. We tried to get back above, let's say, around 403, 404, but could not get above it. Tomorrow, that's going to be the level I'm calling on the upside. So above this level, we're going to watch towards upside action. So let's say above 403s, we'll look for that upside action. Below 397 is the level that I'm going to give on the downside. That's the level that we're going to be careful of. If we break that on the CPI data, you could watch this. This could be the level that we could probably break down big from. We'll see what happens on the SPY. And the Qs we're fighting today did come on up for a little bit, but of course, finding some resistance around the 305s. If you can put a resistance line on that line right there, you can look back at the price action on the 9th. We use that as resistance. That's our green line on the top side. On the downside, we're going to look for what? Below 296. 296 below that, we could get some downside continuation on the Qs. That's what I think we need to watch. What sectors and industries did well today? Actually, healthcare closing into the green there. Stocks like Pfizer, stocks like Novavax, helped out that mission. You can see Novavax here pushing on up there from the 40s to the 53, 54 area. That was about a 30% gain there on Novavax. So keep your eyes on this one. Has been making nice moves on up, and we'll look to see if we see these continue to make moves. I did see also some therapeutic stocks making moves like Cara. So keep your eyes on this one. This one put a big candle, but of course, these could just come turning around. Let's go ahead. Let's take a look at what got hit. Technology got hit, and it was the least down one. Actually, the most down was real estate. We'll talk about some of these semiconductors were actually bouncing back a little bit here. You could take a look at NVIDIA. You saw that close green. AMD closed green. We'll see if we can get day two rallies. You know, was this just kind of a little bounce and a bull trap? That's what the out there is the worry and the concern, because it could just been a little bounce into the CPI. Then we get the flush down. But of course, if for some reason that CPI data comes really low and we are not showing that inflation or inflation topping out, you could see a little bit of a swing right back. So we'll keep these on radar and we'll see what happens. The hardest hit names were basic materials and real estate. I talked about how when we started up on the day, there was actually all industries in basic materials that were actually in the green. And then you started seeing the flip. Lumber flipped around, paper flipped around, silver coming on down there. It just gave a little bounce in silver. Didn't really give much there. And one thing you could see is, like, let's say gold, even gold turning around there, chemicals turning around there. All these names are starting to really get weak, and basic materials have really just started giving up all those gains. So we got to be careful if this is going to continue to happen. One area that I'm starting to see really weak is real estate. As you're seeing these real estate names just getting hit hard there. Tiny says we're going to 268 on the Qs. Oof. That would be definitely some downside action there. You guys can see here on the real estate names, they're getting hit hard. I was taking a look at some of these kind of residential ones first, and we can take a look at some of these. I saw a bunch of these just taking hard hits. I'm going to keep going through these, and you can see these are daily charts. These aren't weeklies. These are dailies, just showing us that each day we're just taking a hit. Look at this American Homes for Rent, even stocks that have renting. And this is not even a kind of a ownership. This is more for the rent that I've been seeing. Rents has been kind of increasing still. We're seeing this even turn around. Be careful out there because there could be some downside action. All right, let's go ahead. Let's take a look. Energy also doing a little bit of a fake out today. MRO started going up at the open, but then quickly gave it all back there. You can see oil's really been weak the last couple of days. We'll continue to watch this to see if they turn around. XOM, you can take a look at ExxonMobil not being able to hold the gains today. It went up there right out the open, up there towards 86.79, but then quickly gave the gains back to 85. We'll see if this can get back on up, or do we just get the complete turnaround in oil names? That's what we're going to keep on watch. Of course, consumer defensives got weak after a really strong day yesterday, so just be careful out there. Stocks like PG turning around. We saw Heinz have a good day. Kellogg's Group had a good day yesterday. Now giving it all back. We'll see if this can get like maybe some 50% retracements from the recent move and then find some balance. That would be near like 71, 75s there for Kellogg. We'll see if that can retrace. All right, my really scary prediction for the Qs is 233. Man, if that gets down, we'll definitely see some downside action follow there. Yogi, like you said, man, smash up those likes, guys. We got over 148 people here. Guys, let's see if we can get to 75 likes. Let's go. All right, I'm going to take a look at some of the areas that I called for shorts yesterday, guys. Did you guys get any of these shorts? Let me know in the chat if you guys were able to nail one of these shorts. Starbucks was one that I gave. I actually shorted this one today on live trading. Maybe got to the profits a little bit quicker towards the 73s. It went down all the way to 71.80s. I hope that somebody was there to nail some of these shorts. Will Chris come on the show to back test? Chris will actually be back on the show tomorrow. Tomorrow's Chris's day. If you want to do some back testing, Mundo, come tomorrow to Chris you all, and that's at 4 p.m. Eastern time. Don't miss that tomorrow. All right, so Starbucks got hit. That was one of the short ones. Who remembers the other ones in the chat? If you were here yesterday, you remember one. Let's take a look. Build-A-Bear was another one that I gave, and you guys saw this one. This one kind of started cracking on down. We're going to look for this one to continue through 17 and keep breaking down. 1850 is the level that I see it on the upside. You could have gotten an attempt there today. Not a bad little push there. Right out the open, went to 1834s, then already back down to 17. That's about 7% gain, and I think this will just keep crashing down. Stocks with Cam. Benzinga hiring. You can always check our hirings and our listings. Cool jobs at benzinga.com. You could also just send it at that, or just look it up on our website. You'll see right there. But we're always looking for great talent, man. If you guys got talent, or you guys got skill, or you guys want to go ahead and push hard, are eager to go ahead and grow, hey, reach out to us. We'll find a way to bring you on to Benzinga. All right. Appreciate you, stocks and Cam. With Cam, let's go ahead. Let's keep going. Starbucks was definitely one of those. The short you was not one of those. A1. Is that a REIT? I'll talk about that if you want. This is energy fuels. I don't know this one. It looks like it's coming on down there with the lithium names probably. I know the minerals have been starting to get hit. Lithium names included there. But let's keep going. The short names that I was trying to get on there. Lucid was another one. I did take some profit today going right into this 1550. I was looking for it to keep breaking on down. Eventually took their 1580s there just to kind of give some profit and continue working. I still got a little piece of this name here. So we're going to look for this to get down there to the 14, the last little bit. But we could see the ramp back. So today we did take some profit into that little push back. Wasn't a bad move to take some profit in there. Now we're going to go ahead and see if this can continue. I only got a very small amount of shares left here, guys, to kind of give it into perspective. It's less than like 1/8 of the position left now, and we'll just see if this can continue. breaking on down. That's Lucid. Best Buy is the other one I gave, guys. Remember, I gave a couple yesterday, and I was watching this all throughout the open. I wanted to see this 91 crack, 91 crack. Finally, when I stopped looking at the market around 11 a.m. Eastern time, boom, we got that crack, and it came on down there towards the 88. That was a 4% move just from that crack alone. You didn't have to get short right out the gates there. So great short opportunity there in Best Buy. I hope that you guys were able to catch that, as we talked about that way before the open, guys. We talked about that yesterday. Not too bad, right? 4 out of 4. Can't go wrong there. All right, we'll take a look at to see what happens on these. Tesla was another one that kind of started coming on down strong. We'll see if this can continue leaking. And I'm going to give you guys a new one here. I'm going to give you guys ATVI. Why? Because a lot of people have been buying this up because of the purchase from Microsoft. But I do see the gap on the downside action, and I'm starting to see electronic gaming and multimedia crack down today. I saw EA really start cracking. So let's see what happens to these and if they continue on the downside. I think EA had earnings maybe after the close there, because it is popping a little bit. So just pay attention. We'll see if the earnings report can hold it up. What's up, Richard? How we doing out there? A1 LAC waiting for an entry. Yeah, these kind of lithium names have been getting crushed. Vroom being mentioned in the chat. Ah, man, that Vroom is just getting crushed right now. Vroom is very close and similar to another SPAC that got destroyed too. And I'm not going to say that it's exactly like this, but be careful, guys, because look at this one. This is Car Lots. Does the same thing, selling of used cars, and you can see down there to 78 cents. So you could see Vroom kind of turn like that too, especially as you see Carvana not doing well also. It's not like Carvana has been doing well at CVNA, and you can see how this one just been coming on down, coming on down, coming on down. That's why you're seeing those get hit, and you got to be careful and know what is the relationship and the stock, maybe a bigger stock that's getting hit harder and causing your stock to get crushed. All right, let's go ahead. Let's keep it going here. We'll talk about some other stocks here. Like always, we'll take a look at what was hit and what was not. If you guys got something to take a look at it, throw it up in the chat. Hertz talking about Unity. Unity getting hit. Is this earnings? Yes, it is. I talked about this, and I actually wanted to get this stock down there towards 30 or 25. Reason I've been talking about this is that I've been looking at it, and I wanted to get it about half of the IPO price, around $30. It opened around $60 to $70, so around 30 to 35 is where I was looking for it. Now it's gotten half there. I'm going to start taking a look at this underneath 30. Unity, I actually like it underneath 30. So this could actually be an opportunity for us, Hertz, as we're seeing Unity take a hard hit off the earnings. Man, I need to see those earnings. They probably got crushed there. I haven't had a chance to take a look at them. I was watching the Cannabis Insiders just like you guys probably were. Hey, they catch me every time. Let's go ahead. Let's take a look there at some other stocks on out there. What happened to Affirm? Affirm, what's going on in Affirm? Looks like it's going sideways right now. We'll see what happens on Affirm to see if this can get moving. Housing market and auto market price are starting to really come down now more and more. This is an important factor here. So let's talk a little bit about that, right? And so when we talk about this, what Zen Bush is just talking about, how the housing market and the auto market prices are starting to come down. Really, I don't see the housing market prices coming on down, but hey, maybe you're seeing something that I'm not seeing, Zen. But it's a starting of the sign, right? Because one of the things that the Fed is trying to do is create what's called a soft landing, right? And they're also trying to increase the interest rates to go ahead and fight inflation. Where? In the housing markets and, of course, the auto markets. So we're going to definitely pay attention to see what's going on in there. One of the things that you can clearly see is that in the auto markets, there are starting to come on down, and that is going to affect inflation. This could go ahead and show up on CPI, actually giving us a little bit more down here. So one of the things that I'm trying to keep an eye out on is if this auto manufacturing and the used cars inflation comes down, is that a sign that we're starting to peak on inflation in certain area that's a big factor in the CPI data. It's a big kind of factor. It's about zero point 0.4 of the percentage there. We're gonna keep watch to see what happens. Do we see that turnaround there? We'll find out tomorrow. All right, guys, let's keep it going, guys. It's about 4:49 here. We'll find on out here. Looks like Jay's running a little bit late, but we'll see what happens with Jay if we're able to get him on before we get on out of here. Let's go ahead. Let's take a look at some other stocks out there and what is moving. All right, so taking a look at some other names here, the utility names. What's going on out there? Just give me 1 second, guys. All right, was trying to look to see what's going on here. All right, just give me 1 second. I'm just trying to make sure Jay has the correct link here. Boom. All right, let's go ahead. Let's keep it going here. I'm looking at the utility names starting to suffer, guys. And then this is the interesting part. This just shows us the interest rates, right? And I showed this chart yesterday if we were going to start bouncing. And you can see we're testing this line multiple times. Do we give up that line tomorrow? That's what I'm going to really be watching, because if that line goes, so will the utility names. Utilities like Duke are hanging on, very similar line. We'll see if these can get on back towards the 115, or do they keep breaking on the downside? All right, we'll see what happens there. Let's keep it going. I did see a shout out. I'll say a shout out because Biden mentioned Southern Company today. Let me see if that actually got the stock to move up. No, it didn't even get the stock to move. It was trying to, but yeah, it didn't get to move. We'll see what happens on these utility names as they've been getting crushed lately. All right, PCG is one that I've been watching. It's been going down there. Hasn't come back there towards the 13. All right, what do you guys got to take a look at? I'm going to go ahead and look at some of these names that I've been looking at. And today, airlines bouncing back today. It looks like the reopening trade was starting to come on back. I saw more of kind of the housing plays doing well, lodging doing well up there. About 6% was Hyatt. Marriott was about 3%, but these have been really coming back down. I'm wondering if Airbnb is going to start taking a real beating. I mean, look where it's at now. It's at 115. I'm glad I got out of that swing trade. You guys see why you get out? Because that red was when we got out, but if we would have hanged on, what would have happened? Boom, it could have came down there towards 115. Next thing you know, we're holding a bag. That's why you always got to know when to get out, guys. Know when to get out is so important. I got caught holding a genie bag, and I learned a big lesson. I talked about this on At the Close. I think it's important for you guys out there to kind of hear about the lesson, right? And so when we're taking our investment account, and that's what I try to do, separate accounts, try to stay in the right account. One of the things that I did is when we're in our investment account, it's very hard to trade our investment account. But one of the things that happened to me was there was a point in time where I kept the stock past the levels that I normally would keep it because I looked at it as an investment. This is where we want to go ahead and kind of separate from here. We want to go ahead and just cut the loss. It's okay to cut a loss on an investment, or even okay to cut it break even. If you're seeing it, it's going to go ahead and just tumble back down towards support. This is where I went ahead and I learned from this lesson. Of course, I'm still holding one of those bags. It's Genie. We'll see what happens. But like always, be willing to let go of that investment is going to be so important. Just like we get rid of it when we're trading, get rid of it. It's okay to get back in it at a cheaper evaluation, or maybe it comes down a little bit and then comes back up through your number and you get it again. But the hard part is seeing your stock just get crushed, like we're seeing stocks like SoFi. SoFi got completely hit hard there, and very similar situation. I was warning around 16 that this could be a very similar stock like Genie and come back all the way back down there towards maybe potentially $5. Now we're seeing it at 536 coming on down. And a lot of this because, you know what? People are kind of fighting this investment, even though they really like the story. the fundamentals might even be looking not too bad because you saw a decent earnings report, but the technicals are saying stay away. And sometimes when the technicals say stay away, we got to go ahead and do so. All right, guys, let's go ahead. Let's get into our interview time. Smash the like, show us some love. I tried to give you guys some true advice today, some transparency from me holding a bag and Genie. It happens. And one of the things that it's all about is the learning lesson, right? It's not just about that, hey, you're holding a bag. I mean, everybody eventually holds a bag. But it's about learning that there's certain times to let go of an investment, especially if you're seeing it come on down. You can always get back in. The one thing that we don't want to do is just get caught in a stock. And next thing you know, you're holding the bag. All right, let's go ahead. Let's dive into our interview. We're going to get into our interview with Jay Hatfield, founder, CEO, portfolio manager of Infrastructure Capital Advisors, coming on just next.
I tell all my CEOs, this is a very, very, very important platform. And look, all the other platforms are important too, but you're up there now. You're way up there.
Best investments you can do in your future is actually go and re-educate yourself on credible sites and credible resources like Benzinga. You guys have been killing it.
The comment section on this show is remarkable. Like the quality of the combo, and just big shout out to you and your community.
So I love about you guys, you just had all your callers in right then. And it's all about the community here at Benzinga.
All right, let's go ahead. Let's bring on Jay Hatfield here, the CEO, founder, and portfolio manager of Infrastructure Capital Advisors. Welcome to the show, Jay.
Great. Thanks for having me on, Mitch.
All right, I'm super excited. Let's go ahead. Let's dive on in. Let's do a little icebreaker here. What's one thing that you would tell your younger self, or maybe a young investor out there that's just getting started? What would be that advice that you might give them?
I would never invest in a stock unless you know what both the earnings yield is and the dividend yield. So I prefer earnings yield to price to earnings ratio because it's like a cap rate if you do real estate. So another way of saying it, don't give people money unless they promise to give you money back regularly, at least in earnings, but preferably in dividend yield. If you focus on that, you don't blow up in Peloton, in all these money-losing companies. Coinbase looks like it's blowing up in the aftermarket because many of them, particularly Peloton, haven't turned profitable yet. And that sounds easy, but when I was an investment banker at Morgan Stanley, we didn't let companies that were unprofitable go public. Obviously, those standards have been loosened, but there is a reason for that. They're super risky, and you can have not just a mark-to-market loss, but an impairment.
Yes, definitely. One of the things that we're seeing out there, there's a lot of those kind of companies that are taking the hit, and a lot of that based on if we're not making profits, it's hard to stay around, right? Especially in an environment like we're in. Let's get into more of InfraCap Invest and the strategy. One of the things that I was looking into is there's a statement here that it's income emphasis focus. What does that exactly mean for everybody out there?
Well, so it's just what I was starting to talk about, which is at a minimum, you need an earnings, reasonable PE ratio, which means a good earnings yield. But even better is if they pay a substantial amount of those earnings to you every quarter. Our funds pay monthly, but we get the underlying investments pay us quarterly. And so what's wonderful about that is, if you need the money for your expenses, you can use that to cover part of your expenses without selling stock. Or even better, if you, every month you can take those proceeds, and if the market's down like it is now, you can reinvest and take advantage of the decline rather than the decline taking advantage of you.
Definitely something that I'm trying to learn and learn more of. So it's really an interesting kind of feature to look for income, right? And actually looking for that in the fundamentals. I think it's an important time to learn from that. Now, one thing that we are seeing is it looks like we are in a tightening cycle. Where do you think we are in this tightening cycle, and where do you see moving forward?
Well, there's a subtlety about tightening cycles. which is the Fed controls the short end of the curve, the Fed funds rate. And then what happens is an initial portion of the tightening cycle, the long end goes up. But you may have noticed that the other thing about the long end, 10 years and 30 years, is that's a global market. So if the US 10 years trading off, that means most European 10 years are probably trading off as well. And even other international bonds like Chinese bonds, Japanese bonds. So what's happened, the Fed has driven the long up way up. And now the US 10 years, the highest in the world. It's at 3%. Germany's at 1%. UK is at 1.8%. So we think that the long end fully reflects the Fed tightening. And that if we're correct about that, and that is a big if, just to be clear, then that should stabilize the stock market, because the key, another sort of fundamental point that I would try to drive home, is that interest rates matter about the same to all stocks. There's an urban myth that it only impacts technology stocks, but because almost all public companies turn profitable, even if they're unprofitable now, they're supposed to turn profitable in 2-3 years. Therefore, they all are what's called long duration or interest rate sensitive. So fair value on the S&P, we calculate at a 3% yield is about 4,100. So we're close to fair value. But if we go to 4% on the 10-year, it's 3,600. So we have another 15% of downside. So this view, I think that if you want to try to position well in the market, you have to have your own view on interest rates. We think they stabilize. We're not saying you should go run in and buy a bunch of 10-year treasuries, but they're not going to sell off dramatically from here. Mostly because we think the rest of the world is going to slow down, have recession in Europe because of their failed energy transition. And then that will reduce inflationary pressures, and then the Fed will back off. So, but keep that distinction between short-term rates, Fed funds, and the 10-year. And the 10-year is what matters, and the 30-year, to valuations on the stock market.
Definitely. I do like how you mentioned that it's not just tech stocks, right? I mean, all stocks are essentially interest sensitive. Let's go ahead. Let's take a look here. You just mentioned kind of energy in Europe. You know, one of the things that we're starting to see, and we've been seeing it at least in the stock prices, a little bit of a pullback in energy, at least in oil here. Is that what you're seeing? Are you starting to see a little bit of a topping here of this energy, or is it just kind of more of a pullback that we've been seeing?
So we do have a pipeline fund, and so we do study the global energy market very closely. And what we've been saying, and we always use a range for oil because it's a highly irrational commodity. So any short-term activity is most likely some sort of overreaction to like a fear that China is always going to have COVID or whatever today's fear is, or for that matter, it could blow up to the top. Like, oh, you know, there's a thought like Russia wasn't going to be able to export at all. Well, that's not the case. So we're using 100 to 120 while the Ukraine war is going on. You know, there's very strong demand, international demand now for jet fuel, which didn't exist last year. So very strong demand picture. We think the COVID will get resolved eventually over the summer, at least in China. So we're relatively bullish. So we're not saying we won't go, you know, below 100, but it kind of indicates that it's a buy. But then you fade it. If it starts going up over 110, you fade it. But all the companies are doing spectacularly well. So we would look at weakness, particularly in conservative companies like the super majors or our pipeline companies through our pipeline ETF. You know, again, we want to get paid to wait, and energy is dangerous enough without getting dividends. But we do think that if they, you know, continue to weaken up, that would be an opportunity to add, because we see during the summer demand accelerating and prices maybe heading closer to the top end of the range.
Yeah, I've talked about that too. I've been watching to see what's going to happen in winter with natural gas. It's going to be really interesting to see if we do get those spikes as we get closer towards out of the kind of like the low cycle. Let's go ahead. Let's look at now. I want to talk about REITs. You know, that's one of the things that you guys have a specialty in, and one of the areas that I'm starting to see weaken up a little bit. And I was showing the sector chart of real estate a little bit earlier. Is there any area in REITs that you're seeing some opportunities in right now?
We actually think that most REITs are probably a buy here. particularly in the pandemic recovery sectors like office, retail, hotels. But you even saw today. So you're right. REITs are very weak today for no apparent reason. But if we think it's more rotational, REITs have held up pretty well relative to tech. So if people are buying tech, they'll sell REITs. But you may have seen there's been a number of buyout offers, and Prologis offered to buy Duke Realty today. But perversely, that might have weakened them up because Prologis stock kind of cratered when that happened, and they're a big company. But we would, be buyers of those cyclical recovery REITs because we think people have gotten too pessimistic about the use of real estate. We all use the internet, but you do need real estate as well. So, and people are going to go back to the office, and when they go back to the office, they might need more space. So we're pretty optimistic about REITs, and like really, our fundamental philosophy, most of them pay pretty substantial dividends. So again, if we're wrong, we're still right, because if you hold on to them and you're getting 3, 4, 5% yields, eventually they'll find a floor and you'll start to get your investment back, and you can use that cash to redeploy, buy more stock, cover your expenses. So that's what we really love about income investing is it's not like buying Peloton at 170 and routing it to 12. If you bought something, a good REIT yielding 4 or 5, it's down 30, 40%. Well, then it yields 6.5, 7, unless there's something fundamentally wrong, which we don't believe there is. But so you can make mistakes with dividend stocks, but they're usually more established companies that are profitable with tremendous assets. So I would emphasize to, new investors, the most critical thing is to not blow up and impair capital. It's okay. Like if you buy a REIT a little bit expensive, it trades down $5, that's not the end of the world. But if you get into Coinbase at 250 and now it's at 66 and you're not getting paid dividends and it doesn't have a lot of earnings, that's what I call an impairment of capital. You want to avoid those because it takes a lot of wins to offset that huge loss.
Yeah, they say, I don't think it's the sexy trade right now that's making the money right now. It's the boring, safe dividend income making trades that are looking a lot better right now.
Yeah.
Now, the last one I want to bring into it is let's talk a little bit about inflation. I know that it's on everybody's radar. We're starting to see some factors of maybe used cars slowing up a little bit. Do you guys see any inflation factors that are still at play here? And how do you see it right now, Jay?
Well, this is kind of another fundamental law of investing. If you want to predict the cycle, you need to have 2 primary inputs: Fed policy. We know what that is, terrible or hawkish, and the housing market. Housing is the most cyclical sector. It's been implicated in 11 out of the last 11 recessions post World War II. So we would urge your listeners to focus on the housing market. So mortgage rates have gone to 5.5% from 280. So housing's likely to slow, which should reduce the price increases we saw. We saw 20% last year, which should then slowly reduce rents, and rents are 33% of CPI. So we think that inflation will cool, but there's going to be a lag because the housing market operates with a lag because of the lag in getting mortgages and purchases and then translating into rents. So we think in the second half of 22, you'll see slowing inflation. We think the world demand for a lot of commodities will be dropping, and oil might peak during the summer after the summer driving season. So in the fall, you might see lower inflation. So the Fed policy will be successful, just like it was successful in driving inflation to almost 10% through quantitative easing. Quantitative tightening plus increases in rates will be successful. We just don't know how quickly and whether the Fed will be irrational and not back off soon enough to avoid a recession. But we do think that the U.S. is much better positioned than the rest of the world. The rest of the world would go into a recession. We'll probably be fine, or maybe have a very mild recession, because we have a more resilient economy than Europe and Asia.
Yeah, definitely. And they're definitely fighting a little bit more of that energy crisis than I think we are here at the home states. We'll keep watching. Definitely. I appreciate you coming on. Thank you for joining us, guys. Definitely. Where can they find more about kind of the funds and the different?
www.infracapfunds.com.
Perfect. And guess what, guys? All you got to do is just go to the description. Links right there for you. All right. Thank you for joining me, Jay Hatfield, founder and CEO of Portfolio Manager of Infrastructure Capital Advisors. I appreciate you joining me, and we'll love to have you back on here.
Okay. Thanks, Mitch. Great to be on.
Thank you. All right, guys, that's going to do it for us today. Another day that we go into a little bit of overtime. I hope we saw a lot of people join up the interview in the middle of it. If you guys want to catch our stock talk, definitely just rewind. We talked about different sectors and short stocks that we were looking at just one day prior, 4 out of 4 on those shorts. So we're going to definitely talk, and we'll keep looking at the ideas out there. Just hit the rewind button if you joined a little bit late so you guys can catch all that action. And I'll see you guys next time on live trading tomorrow at 9:05. Like always, we got more action on Benzinga coming on up. We'll take you on over to a webinar. You guys check it on out. I hope you guys enjoy it, and definitely smash the like, and see you guys next time.